following the news and the announcement around SEC, Gary Gensler kind of announcing he's going to ban payment for order flow. Well, not going to, but it's on the table, as his words mentioned. He's on the table. So the share price of Robinhood dropped almost 8% yesterday during the trading session. I mean, it recovered a little bit before the closing bell, but this morning, before the opening bell, pre-market, it was down more than 4% at the time. But when you actually look at how the stock performed today, it wasn't that bad concerning the announcement. So closed on the green, gaining 156%. And when you look at where it closed the other day, previously 45 and now sitting at 44, it's really, less than $1 per share. So I will say the market reacted pretty good to the announcement. And I think it's not a surprise because pre-IPO, this is something that the company Robinhood itself, let the investor know by saying, hey, this is a risk. We know, we are aware of it. And if the SEC bans payment for order flow, which at the time, we know that now 80% of the revenue of Robinhood is coming from trading revenues, which is payment for order flow. Now, the thing is, the market sentiment, it's also leaning on the fact that, hey, maybe the SEC announcement, it's kind of overblown. So they're not really thinking that this is serious, all right? Because when you actually look at how the market is structured around payment for order flow, it looks like things might be a little bit more complex than just shutting off the whole full payment for order flow thing. I mean, even though from a risk and from a market transparency, conflict of interest thing, it will make sense, but I think things are more complex than that. So I want to try to answer in this video, actually, what will happen to Robinhood stock or to Robinhood, the company, let's say 2 weeks from now, 2 months from now, the SEC actually follows through and bans the full payment for order flow completely, like it is done now in Australia, in the UK, and in Canada. All right. So when you look at what Interactive Brokers founder said a couple of weeks ago around payment for order flow, he doesn't believe that the SEC can just, do that because this is something that's been around. This is a practice that has been around in the US for the last 200 years. Well, maybe true. But when you actually get a closer look to how this payment for order flow works, especially for retail orders, it kind of gives you an incentive, an insight of what can potentially be a turnaround from Robinhood, or a process. I mean, a process that Robinhood can actually put in place in order to continue to propose both, free trade commission to the customers, because I don't see Robinhood completely starting to charge the customers, because this is definitely bad for their business and their image. Specifically because this is their marketing positioning. Robinhood is literally positioning themselves as a company helping and providing free trade commission to the little guy having access to the markets, as opposed to multiple years ago, 10, 15, 20 years ago, where this was only reserved and dedicated for sophisticated investors going through their brokers, which they were paying, $10, $25, $30 for a trade. Can you imagine that today? Obviously, no. Well, let's say, for the sake of this example, okay, you have a security that is actually trading around 48. So if you want to buy the security, you will be asked to pay $58.25. All right. If you want to sell it, they want to ask you to pay $58. So we have a spread, a difference between the two, around 25 cents. Right now, what companies like Citadel and Virtue, which are called internalizers or wholesalers, are doing, they are getting all these orders from Robinhood and other brokerages as well, like TD Ameritrade, Schwab's, Apex, and they take the whole package, the whole volume, and they say, okay, we are going to give you best execution or price improvement, because instead of buying the security around 58.25, you can buy it lower around 58.15, saving 10 cents per share, right? And instead of selling it at 58, you can actually sell it even higher at 58.10, saving 15 cents, all right? So the 10 and 15 is actually what the wholesaler is capturing and might charge you, the final customers, 5 cents, or whoever is providing the email, 5 cents, and reversing back or giving back $3 or $2 per trade to Robinhood. And that's how payment for order flow works as of now. Now, the thing is, if the SEC bans the whole payment for order flow thing, Robinhood can actually turn around and say, well, we might be also being a market maker for that matter. I mean, why not be also a wholesaler like Virtue or Citadel for that matter? Why? Because by matching the buyer and the seller, we can capture the spread, the 25 cents, and we'll still give them price improvement. We'll still give them best execution price. Best execution. We'll still give them free trade commission on our app. So the business model doesn't change. The customer experience doesn't change. The price or the revenue model changes a little bit from a technical standpoint, because instead of getting paid by an external party like Virtue or Citadel, which are internalizer or wholesalers, we are actually getting also a wholesaler and capturing the spread. All right. So by doing so, it might solve two things, actually three things. Robinhood keeps what they already giving as benefits, and selling points to their customers. But on the other hand, it solved the whole market conflict of interest, because Citadel is no more working with Robinhood. And actually, Robinhood is not getting paid for the orders they rerouted, because all of those orders will now be forced to actually hit the lead exchange, the market itself, the NASDAQ or the New York Stock Exchange, from Robinhood directly, solving this whole market transparency and market conflict of interest. But the thing is, it might also set up another whole thing from a market structure standpoint, from the internet broker, founder, because he said if the US crack down on payment, well, you are looking at either Citadel or buying Robinhood, and Schwab by Virtue, and the two sides will be put together into one company, giving you a giant monster in the market who will be even bigger than most of what we can just imagine, making this issue even worse. So just to say that the task is not easy for the SEC, but actually I think the commitment and the mission is there, but we can actually look at how things will definitely unwind for Robinhood moving forward. But hey, if you are still holding on some stocks, some shares of Robinhood, I think depending on your strategy, depending on your horizon, if you're long-term, short-term, medium-term, things might be different, but you will still want to keep a close eye on this as we move forward, because it might unravel pretty quickly.